Hey there! Trust, majority of you must have either watched the Budget 22 live or at least read and attended its dissection done by the experts. It's always good to be updated. However, major question is, do we really understand terms like fiscal budget, capital spending, revenue receipts, etc. or know why budget is so important for the economy? To me, these terminologies sometimes sounds like some alien language, and considering this, we have brought to you easy to understand explanation of few vital terminologies used in budget again and again, which will not only help beginners to understand the budget better but also acts a refresher to financial wizards. So if you like it, do share it and subscribe for more updates. First, let us understand what the Union Budget is. It is a comprehensive report of the government's financial statements containing all expenditure and all revenues, actual numbers for the year going by, revised estimates, and forecasted number for next year ahead, that is budgeted estimates. In India, our financial year runs from 1st of April to 31st March of next calendar year, and budget is an annual report card of what has happened last year and what is the plan for coming years. Starting from the year 2017, it is presented on every 1st of Feb of each year. Now, let us move to the taxes, which are classified as direct and indirect taxes, where direct taxes are the taxes that are levied on income of individuals or organizations. Income tax, corporate tax, inheritance tax are some of the examples of the direct taxation. Income tax is the tax levied on individual income from various sources like salaries, investments, interest, etc. Corporate tax is the tax paid by companies or firms on the income they earn. On the other hand, indirect taxes are those paid by the consumers when they buy goods and services. These includes excise and custom duties. Customs duty is the charge levied when goods are imported into the country and is paid by the importer or exporter. Excise duty is levy paid by a manufacturer on items manufactured within the country. Usually, these charges are passed on to the consumers. Since we understood the most dearer part of the taxes for common man, let us also focus on why this budget is so important to all of us, or what is the impact of this budget. The budget impacts the economy, the interest rate, and the stock markets. How the finance minister spends and invests money affect the fiscal deficit. The extent of the deficit and the means of financing it influences the money supply and the interest rate in the economy. Higher interest rate means higher the cost of capital for the industry. That means lower the profit and hence lower the stock prices. The fiscal measures undertaken by the government affects public expenditure. For instance, an increase in the direct taxes would decrease the disposable income, thus reducing demand for the goods. This decreased demand will translate into a decreased production, therefore affecting economic growth. Similarly, an increase in indirect taxes would also decrease demand. This is because indirect taxes are often partially or completely passed on to the consumers in the form of higher prices. Higher prices implies the reduction in the demand, and this in turn would reduce the profit margins of the company, thus slowing down production and the growth. If you are still on this with us, kindly consider hitting the like button to make YouTube Baba happy and motivate us. Now, swiftly understand difference between the revenue budget and capital budget. Starting with the revenue budget, which consists of revenue receipts of the government, that are revenues from the taxes and other sources, and its expenditure. Revenue receipts are divided into tax and non-tax revenues. Tax revenues are made up of taxes such as income tax, corporate tax, excise, customs, and other duties that the government levies. In non-tax revenue, the government sources are interest on the loans and dividends on the investment like PSUs, fees, and other receipts of services that it renders. Revenue expenditure is the payment incurred for normal day-to-day running of the government department and various services that it offers to citizens. The government also has other expenditure like servicing interest on its borrowing, subsidies, etc. Whenever the government spends more than it earns, that means whenever the revenue expenditure is more than the revenue receipt, the difference is called as revenue deficit. Opposite scenario of the same, where revenue receipts are more than the revenue expenditure, is known as a revenue surplus. The capital budget is the different form of a revenue budget, as its components are of a long-term nature. The capital budget consists of capital receipts and payments. Capital receipts are government loans raised from the public, government borrowings from the Reserve Bank and treasury bills, loan received from foreign bodies and governments, disinvestment of equity holdings in public sector, enterprises, securities against small savings, state provident funds, and special deposits. Capital payments are capital expenditure on acquisition of assets like land, building, machinery, and equipments. Investment in shares, loans and advances granted by central government to the state and union territory governments, government companies, corporations, and other parties. Now, since you have understood about disinvestment and where it falls, do not miss the major investment opportunity coming your way in the form of LIC IPO, for which you need one Demat account. If you and your loved ones are yet to have Demat account, link to open the same with leading stockbroking houses is mentioned in the description box. Do check it out. Last but not the least is about Finance Bill, which you must have seen our Honorable Finance Minister Nirmala Sitharaman ji proposed to present in front of Parliament towards the end of her budget speech. In the Finance Bill, the government proposal for the levy of new taxes, alteration in the present tax structure, or continuation of the current tax structure beyond the period approved by Parliament are laid down. The Parliament approves the Finance Bill for a period of 1 year at a time, which becomes the Finance Act. We hope, friends, with this information, you can understand the budget in much meaningful manner. If you like our efforts, do subscribe to our channel